Let's jump right into this explainer. Today, we're dissecting Navitas Semiconductor. We're going to look at their brilliant technological moat and stack it up against an incredibly harsh financial reality. We're looking at a company right at the epicenter of a massive tech shift. They're executing a deliberate and, frankly, pretty painful corporate pivot, all while trading at valuations that demand absolute perfection. Now, if you've been following the semiconductor space at all, you know AI is taking up all the oxygen in the room. But beneath those shiny new GPUs lies a fundamental, totally unglamorous problem: power. 1 megawatt. That's the staggering power demand of a single next-generation AI server rack. 1 megawatt. To put that into perspective for you, entire data centers used to run on what just a single rack of NVIDIA Blackwell or Rubin chips is going to demand in the near future. Individual GPUs are pushing past 1,000 watts each. We're entering this wild era of hyperdense computing, and honestly, it's fundamentally breaking the legacy electrical infrastructure we've relied on for decades.
So how do you power an AI revolution without literally melting the grid? This is the existential physics bottleneck facing the global tech industry today. You literally cannot run next-gen generative AI models at scale if your facilities are catching fire or pulling so much power that the local utility just cuts you off. The industry is desperately searching for a way to distribute massive amounts of energy efficiently. And as we'll see, traditional silicon simply cannot handle the heat. Our roadmap for this explainer covers the AI power crisis, the wideband gap solution, the Navitas 2.0 pivot, onshoring the supply chain, valuations and red flags, before wrapping up with the final verdict. Let's get to it. Section 1. The AI power crisis, the physical bottleneck of generative AI. Let's establish exactly why traditional silicon is acting like a congested one-lane road for AI computing. The crucial point is that at multi-megawatt densities, legacy 54-volt alternating current architectures just fail. They suffer from catastrophic energy loss. Think about it. When you push that much power through standard 54-volt lines, the current gets incredibly high, and high current means massive resistive losses. To deal with that, you need unmanageable, insanely thick copper cabling. But it gets worse. All that lost energy converts directly into extreme heat, completely overloading traditional data center cooling systems. Add the fact that utilities are enforcing strict power usage efficiency, or PUE mandates, and data center operators are quite literally being forced to find an entirely new power architecture just to keep the lights on. Section 2. The wideband gap solution, frictionless superhighways for power delivery. This brings us to the fundamental solution driving the wideband gap semiconductor renaissance. If standard silicon is a congested dirt road, wideband gap semiconductors are frictionless superhighways. We're talking primarily about materials like gallium nitride, or GaN, and silicon carbide, or SiC. These materials let electrons move with incredible mobility. They handle extreme voltages and switch on and off at blistering frequencies with minimal thermal loss. Because they're so ridiculously efficient, you can drastically shrink the size of the components. That frees up vital real estate inside the server rack for what really matters: more compute power. The paradigm shift here is stark. We're moving away from legacy 54-volt AC architectures with their high current levels, massive bulk from thick copper cabling, severe distribution power loss, and absolutely zero wideband gap BOM share. Instead, we're looking at next-gen 800-volt DC architectures. We're talking low current, minimal copper, and Navitas safe engine SiC integration hitting over 97.5% peak efficiency. But here's the kicker, the really vital metric. Wideband gap jumps to a whopping 64% of the rack power bill of materials. That is a massive expansion. So, why Navitas specifically? Well, traditional discrete GaN components are actually pretty fragile. They need external drivers and are prone to frying if the voltage spikes. But Navitas completely dominates this niche because they monolithically integrate the driver, the control, and the protection circuitry right onto the very same chip. Their autonomous detect and protect logic triggers in just 50 nanoseconds. I mean, when a single minute of AI server downtime costs thousands of dollars, this integrated reliability acts as a massive competitive moat against other discrete component suppliers in the hyperscaler space. Section 3. The Navitas 2.0 pivot, surviving the financial trough. Now, let's see how this technological supremacy translates to the balance sheet during a very deliberate and definitely painful corporate transition. Navitas originally made its name in low-margin consumer chargers, the little bricks used to charge your smartphone. But to power the AI revolution, they had to pivot.
They consciously withdrew from that commoditized legacy mobile business to focus entirely on high-margin, mission-critical enterprise AI data centers and EVs. This pivot sparked a near-term revenue collapse, but it was a necessary move to secure long-term profitability.
The V-shape in their financials is pretty clear. Total revenue bottomed out in Q4 2025 at $7.3 million, down almost 28% sequentially, but guidance points to a recovery reaching $10 million by Q2 2026. More importantly, look at the high-power mix. They've gone from the minority of their business to the overwhelming majority. The pivot is definitely working.
And this pivot feeds directly into profitability, driving gross margin expansion. Their historical 5-year average hovered around 36.1, but by Q4 2025, it actually hit 38.7 and crept up to 39.0 in Q1 2026. As high-power AI and EV sales become the majority, that premium pricing power is driving a structural upward trend in margins. It absolutely validates that enterprise clients are willing to pay a premium for this tech.
Section 4. Onshoring the supply chain. Neutralizing geopolitical risk. Beyond just the technology, Navitas is executing some real masterstrokes in corporate positioning to neutralize geopolitical risk. Like many, they operate a fabless model, and were historically reliant on TSMC in Taiwan. In today's climate, that's a massive geopolitical risk, especially if you want U.S. government or defense contracts. To fix this, they formed a long-term strategic partnership with GlobalFoundries, who happens to be backed by $1.5 billion in U.S. CHIPS Act funding for a facility in Vermont. Throw in some secondary sourcing in India via Semiconductors, and suddenly they've built a highly resilient, geopolitically insulated manufacturing base. Super smart move. Section 5. Valuations and red flags. The reality of the bear case. Okay, so the tech and the strategy are stellar, but we have to ground this explainer with the cold, hard reality of their current balance sheet. This is where things get a bit bumpy. Management filed a massive $250 million universal shelf registration, accompanied by a $125 million at-the-market, or ATM, stock offering program. This staggering multi-year funding mechanism basically secures their survival until the big 2027 AI deployment cycles kick in. But let's be real, it aggressively penalizes existing shareholders by heavily diluting the stock. And the multiple you're paying for those shares? It's pretty eye-watering. When compared to legacy peers like ST Microelectronics and ON Semiconductor, who trade at EV to forward sales multiples of around 3.5 to 4.8, Navitas is sitting at a hyper-extended 96.3 times forward sales. The market is effectively ignoring their current size and pricing them almost entirely on a flawless, uninterrupted execution of their fabless model over the next 5 years. Making matters a bit more uncomfortable are the optics around insider trading. Executives shed millions in stock, with the CEO himself selling 2.15 million shares just before that $125 million dilution announcement. Now sure, some of this is standard compensation restructuring, but the intense open market insider selling right before a major dilution event injects a thick layer of institutional skepticism regarding any near-term upside. So why do they desperately need all that cash from dilution? Well, negative $107.76 million. That's their 2025 operating loss. Even with expanding gross margins, this massive number reveals the immense inelastic R&D and fixed cost burden of the fabless model during early-stage tech transitions. They have to spend like giants to win those hyperscaler contracts, but their current revenue base just isn't big enough to absorb those fixed costs yet. Section 6. The final verdict. Navigating the AI infrastructure compounder. Let's pull all these threads together. This timeline is the Catalyst roadmap, outlining exactly what investors need to monitor. May 2026 is all about capital market outreach and conferences. Q2 2026 is crucial for earnings execution and India sampling. Late 2026 brings the GlobalFoundries 200mm fab ramp in Vermont. And finally, the ultimate prize, the 2027 to 2028 mass deployment of NVIDIA's 800-volt DC architecture. Because of these conflicting realities, the consensus lands on a neutral rating for the immediate term. You've got undeniably formidable AI tech and brilliant hyperscaler positioning, absolutely. But it's offset by an extreme valuation premium and massive cash burn. Ultimately, the true revenue inflection just won't meaningfully materialize until those 2027 service cycles begin. It requires immense patience. Navitas has the technology to power the AI future. But is the stock priced for perfection today? We'll leave you at that final thought to ponder as you evaluate the true cost of the artificial intelligence power boom.
Thanks for joining me on this explainer, and I'll catch you in the next one.